Hi there, welcome to Kneppy Invests. We are halfway through December. I'm recording this video on December 15, which means the December quarter is just about to finish, which also means we are going to see some December quarter Appendix 4Cs being released in about 3 to maybe 4 weeks. But I am still looking at some September quarter results from companies. And in today's video, I am going to be featuring a company I haven't really looked at into too much depth, and that is Harris Technology. If you don't know what this company does, you might think they're a pure play technology company. In a way they are, but they in fact are an online retail company that specializes in selling technology. So let's get stuck into it and talk about what this company does in a little bit more detail. Harris Technology's mission is to become Australia's #1 tech seller on all major e-commerce marketplaces. So they do not manufacture any products themselves. They're just sort of a reseller. They do have their own e-commerce site, www.ht.com.au, but they also sell products through online marketplace platforms like Amazon, eBay, Kogan, and Catch. The little diagram on the left just shows you exactly what they're doing. It's called, what is it called? A fly or a spin wheel or something like that. And in the center, you've got Harris Technologies. You have their own website selling tech stuff. You also got the online marketplaces around that are based in Australia. Then you got the international online marketplaces around that. You might think, since Harris Technology is an online retailer, they mustn't be that old, but they were founded in 1986 by Ron Harris. And either he had amazing foresight to see the possibilities of e-commerce back then, or it was a completely different business. Maybe it was sort of a brick and mortar technology retailer, and they just evolved into what they are today. Now, a very interesting past, because at one point in time, Harris Technology was actually owned by Coles Myers, Officeworks, and Wesfarmers. Now, to see when it was listed, we have to go back to 1999 when a company called Swish listed on the ASX. Swish then became Adeffective. I think Adeffective then became Shopley. Shopley then bought Harris Technology, and then some stuff happened, and then about 2 years ago there was a whole restructure, and Harris Technology was either spun out or something happened, and really the current form of Harris Technologies has only been around for about 2 years. And you'll be able to see that when we look at the cash receipts history. The current CEO is Harrison Wang. He's been the CEO since July 2016, and he also has a 30% interest in this company. So definite skin in the game. The question is that too much skin in the game? And the major shareholders all seem to be individual investors. Doesn't seem to be any funds at this point in time interested in this company. And the market cap of Harris Technology is $33 million. That's at a share price of 11 cents. And the ticker code for this company is HT8. Now let's have a look at the financial state of the company by comparing financial year 2021 to financial year 2020. And we want to see if this company is growing over a 1 year period, and how quick are they growing. And if you look at revenue, they have grown that from 13.6 million to 41.8 million. That is a significant growth in that one metric. So if you just looked at revenue, you would say Harris Technology is a rapidly growing company. More than likely, the reason this has grown so quickly was because of COVID-19. Gross margins actually fell from 19.6 to 18.4%. Operating cash flow became worse. They were only operational cash flow negative by $800,000 in 2020 now, or in 2021, that operational cash flow negative by $4 million. But in saying that, they were profitable for both years, $1 million in 2020 and $1.8 million in 2021. They only had $1 million of net cash, but I think they might have fixed that because they did do a capital raising, a price to sales ratio of 0.8 and the PE ratio of 18. I just want to have a quick look at the cash flow statement in the yearly report just to see how the company was performing, see where there are some costs. But there is one reason I prefer to look at quarterly statements instead of half-yearly or yearly cash flow statements, simply because there's a little bit more information in the Appendix 4C when it comes to cash flow statements. But Harris Technology was not operational cash flow positive. They were negative by $4 million, and they didn't do a capital raising after the end of the financial year. They did a capital raising during the financial year, and if I remember correctly, it was done around August of 2020. So everything's coming. I'm starting to remember a little bit more now. Now, one of the reasons they did do that capital raising was because they were operational cash flow positive, and they really needed some capital because of that. Now, when they talked about the capital raising, they did mention it was for growth initiatives. But the way I look at it, this was just for working capital reasons. They just needed to stay afloat because they were burning through cash during the financial year 2021. Let's go back 1 year to the September quarter, first quarter of financial year 2021, just to see how this company was performing at this point in time. Cash receipts, $9.5 million. Now, product manufacturing operating costs were $11.3 million. So straight away, we know this company was going to be operational cash flow negative, and they definitely were by $2.2 million. It was during this quarter they did do a capital raising, but that raising didn't raise the $10 million we saw in the yearly cash flow statement. It only raised $3.6 million. So maybe there were a couple of capital raisings during the financial year, and because it's capital raising, they actually did grow their cash on hand from 1.2 million to 3.3 million. As we turn our attention to the most recent Appendix 4C from the September quarter 2021, the first quarter for financial year 2022, things are progressing quite well for Harris Technology. Receipts from customers have grown, and even though product manufacturing and operating costs have grown as well, that hasn't grown as quickly as receipts from customers. In fact, receipts from customers is now greater than product manufacturing and operating costs. And Harris Technology doesn't spend a lot of money on staff costs, only $548,000 for the quarter, and administration costs only $356 million. So if they can maintain this increase in receipts from customers and actually increase that at a greater rate than the product manufacturing and operating costs, that means this company will actually become more and more operational cash flow positive. They were operational cash flow positive for this quarter by $502,000, and actually it is one of the reasons I decided to do a video on this company. And because they didn't spend a lot of money on investing and financing activities, a fair bit of that did go down to the bottom line, and they increased their cash on hand during this quarter from 3.3 to 3.5 million. Now let's have a look at the receipts history for Harris Technology. This goes back to the September quarter 2016. If we go back to 2016, or between 2016 and 2019, this company was called Shopley, and I do vaguely remember that company and never being interested in that company. And if you look at the receipts history during that period, you probably can understand why, because receipts were falling. And then the company went through a restructure in 2019, and Harris Technology came out of that restructure. I'm not exactly sure what they did, but it seems like it has worked, because receipts for Harris Technologies has exploded over the past 2 years. In fact, it's grown from 3.1 million in the March quarter 2020 to 15.8 million. And if you do calculate the compound quarterly growth rate in receipts over the past 2 years, you get 31%. That's per quarter, that's not per year. So Harris Technology, whatever they're doing is working. They are growing their receipts at a fairly quick rate. And the question I have is whether that's going to translate to whether this company becomes increasingly operational cash flow positive. And if they can show the market that they're doing that, I think that could be the turnaround point, the catalyst for re-rating in Harris Technology's share price. The other thing I wanted to do is just compare Harris Technology to Kogan and mydeal.com.au, which is a funny comparison because Harris Technology use Kogan as an online marketplace. So they are not identical sort of companies, but they're in the same ballpark, and that's enough for me. So I'm comparing cash receipts, market cap, and price to sales ratio for all three companies. And more than likely, you should have to pay a little bit of a premium for Kogan and mydeal.com.au, and you can see that in the price to sales ratio. For Kogan, that is 0.98, and for mydeal.com, that is 0.94. Receipts, Kogan has 885 million. If you compare that to Harris Technologies, which only has receipts of 41.8 million, you can just see the vastly different sizes of the two companies, and that is reflected in the market cap. Kogan has a market cap of 868 million, and Harris Technologies a market cap of 34 million. But if you do look at the cash receipts and the market cap, they're almost 1-for-1, which is reflected in the price to sales ratio. So it does seem like, even though there should be a premium to Kogan and mydeal.com.au over Harris Technologies, it's not a great premium. And if you had to ask me which company I would invest in, just looking at these numbers, I'd be swayed more towards Kogan and mydeal.com, because Harris Technology hasn't got a significant discount to its valuation, even though it's only 34 million. On to the sentiment. What is driving the share price higher or lower for Harris Technologies? And this is the weekly chart going back to 2016, when they were Shopley and were not doing well. Remember, cash receipts from 2016 to 2019 were going down, and that is reflected in the share price. It was decreasing. In fact, in April 2016, the share price was about 20 to 25 cents. And by the start of 2020, as Shopley turned into Harris Technologies, the share price had reached a low of about 0.9 cents. Yes, lower than 1 cent. But we did see a breakout in the share price towards April of 2020, just around the end or just after the COVID-19 financial panic. And we have seen, or did see, the share price increase quite quickly from then on. In fact, the share price increased from about 2 cents to a high of 21 cents over the last 7 months of 2020. A nice 10-bagger for those who held Harris Technology shares during that period. But since the start of 2021, the share price of Harris Technologies has fallen from that high of about 21 cents to a current share price of around 11 cents. And over the past, we'll say 6 months, the share price has been going sideways. And the other thing is, we have seen decreasing volume. So the market is becoming less and less interested in this company. And that's why I do think if this company produces some really good financial results over the next year, we might see a breakout in the share price. And a good price to buy into Harris Technology, where a breakout would be confirmed, is just higher than 15 cents. So that's what I'd be looking for a potential breakout in this company's share price. That's all I have for Harris Technology. Looking at the September quarter Appendix 4C for financial year 22. Also having a look at their cash receipts history and all that jazz. If you do know a fair bit about this company, I'd love to hear your opinion on Harris Technology. So leave a comment, your thoughts, or even a question in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.